Hey everyone, in this video series we're going to be going through some of the past Capstone exams and how to approach them. Now obviously Capstone's very different to the core modules, different structure, different approach, so our videos are also going to be a little bit different. So how these videos are going to work for the main exam walkthroughs is I'm going to be trying to do this from your perspective, and what I mean by that is when you get to your main exam, what you're going to get is you're going to get pre-release information, and on the day of your exam you're going to get a little bit more information. So I'll show you one example. Let's pull up the 2019 main exam, and as you can see, if I just zoom out a bit, so the pre-release starts here basically from the first page. We scroll through all of this. This is all background information, so it's got some information like people talking. There's some key information in there, it gives you some context, and then it gives you some industry information, some extra information about the company and the people, and then it gives you some key information. So you see how it says pre-released? All of this is pre-release. 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 Still going, pre-release, pre-release, pre-release. So there's a lot of pre-release information, right? So we're up to page 13. We started on page 2. So there's roughly 11 pages of pre-release information. Now, the exam itself, you get this extra information on the day of the exam. So you're going to get extra P&L information, extra balance sheet information, and you usually get it for 3 years, right? As opposed to the pre-release information, which they only give you limited information. Actually, there's quite a bit of financial data in there as well, but they give you updated information, and the purpose of that, see, this is all updated information here, updated. So there's about 4 or 5 pages of updated information, then you get to your questions. So you don't get the questions and you don't get that extra information on the day until the day of your exam. Now the reason is that CA tells you they don't want you to pre-prepare your essay. They don't want you to pre-write it. They want you to have some background information so you get some good context for it, maybe have some notes, and come in and do the exam on the spot. That's their advice. My advice to you, and what I've given to all of my students previously, is to pre-prepare as much of your essay as possible. So very similar to how we did the written assessment practice. Same approach, right? In the written assessment too, we also only got the information on the day of the exam, but they gave us a lot of pre-release information. But as you would have learned from watching the videos, is there's a lot that you can actually extrapolate and figure out just by looking at the pre-release information over and over and over, making a few assumptions, having a guess at what the question can be, but also preparing it in a way that you're open to flexibility. For example, leaving in brackets to substitute the actual number that when you get it, just substitute it in. Or maybe it's preparing a paragraph that you have a paragraph already when it like if it goes up or if it goes down. For example, if revenue goes up or if revenue goes down, you've got a pre-written paragraph already, or you can just practice it yourself based on a single paragraph. Either way, my recommendation is come in with a pre-prepared essay that is adaptable, and we did practice that in our videos, so hopefully you've got the idea. And the other reason why I recommend you do that is if you don't come in with a pre-prepared essay, you're going to spend all your time in the exam reading through the information, thinking about your structure, kind of analyzing it, doing calculations, sitting there and thinking, oh, should I do it this way or should I do it that way? If you've got a pre-prepared essay, you're going to come in, you're going to start writing straight away. And, and the other benefit is that by preparing an essay based on the pre-release information, you really have to look at every tiny bit of information. So you'll have to read over it over and over again over the pre-release like 5 times. And if you read over something like the first time, you might miss a bunch of stuff. You read over the second time, you might pick up some extra stuff. You read over the third time, you pick up some extra things. And by the 5th time, you've picked up every little piece of information that you might have missed otherwise. And that saves you from having to do that on the day of the exam, right? If you do it under pressure on the day of the exam, you're going to miss some of those critical steps which you need to link into your answer as a qualitative part of the answer. Alright, so let's jump out of this. We're not going through the CAP119 main exam, we're going through this CAP417 main exam. Now, how I wanted to approach these videos is I only want to approach it from the perspective of the pre-release, not the full exam. And the reason is that's the position that you'll be in. You're not going to get the exam questions, you're not going to get the extra information. So this whole purpose of this video is getting you ready so that you can prepare an almost ready draft essay that you can bring into your exam and use and also adapt, like learn how to adapt it based on only this information. Now you might be asking me, how do I know what to write in my essay if we don't have the questions and we don't have that extra bit of information? Well, we already talked about the extra information. You just leave it as blanks. The questions itself is a harder one. Now, before we get started, what I want to do is I want to show you another work paper, and it's in the Capstone notes. It's a summary of historical exam questions that we've prepared and pulled together for you. And the purpose of showing you this is that there is a trend in questions over all of these years. So in the final exam, you're going to get 3 questions worth 20 marks each. Now, if you have a look at question 1, there is a lot of similarity in question 1. So all of these questions are saying evaluate current performance, evaluate current performance, evaluate current performance. Some of them are a little bit different. It says analyze and evaluate with respect to blah blah, and analyze and evaluate sales channels, analyze and evaluate. So sometimes it gets a little bit more specific, but generally it's just evaluation. So what this means is it's basically all you have to do is it's a financial analysis of the business. So it's looking at the P&L and saying, okay, revenue's gone up. Trade receivables have gone up, payables have gone up, cash flow has gone down, interest coverage has gone down, bank overdraft. So you're not necessarily preparing it based on every single piece of key information or trend, but you're kind of looking for the outliers. So some of that information you can get from the pre-release data. Some of it you can assume based on the qualitative trend in the answer and just kind of leave the numbers blank. So I'll just quickly, and the other aspect is linking it back to qualitative information from the release information. So you don't just say in isolation, sales revenue has gone up, 10%, right? You say sales revenue has gone up because of the new, agreement with our competitor to share, blah, 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 right? So it's link it into the text. And that's why it's really important in this section that we go through the pre-release, take out all of the information that we think could be relevant, and then we look at the financial information and say, okay, sales has gone up, therefore it's because of this, right? Or debtor days have gone up and it's because of this. So we just do that. We have a whole bunch of points, and then we prepare our template essay based on those points, linking in the financial point and the qualitative point. Okay, so that's basically generally the whole approach. And of course, there's a couple of more specific ones where it says, for example, analyze the business with respect to the sales channel or the impact on working capital. It's the exact same approach in that situation, except you make reference to points to that specific topic. So for example, analyze and evaluate their ability to pay dividends. You're still going through and looking at the sales revenue, but you're now linking it to the dividends. So, sales revenue has gone up because of the new contract with this supplier. The increased revenue, assuming costs stay the same, will translate down to higher profit and therefore will increase their ability to pay additional dividends, right? So it's the same approach, but you're just being specific and linking it to what the question's asking you to do. So question 2 is probably the harder one in terms of it's less consistent throughout the years, because you might have a quick look at this and say, oh, there's not an immediate trend in these types of questions. For example, evaluate options to manage potential excess demand, options for managing mediation damage, evaluate a proposal, evaluate the impact from potential acquisition. So on first look, they seem kind of different, but what if you actually go through and categorize them like this, they either fall into one of these two categories, either evaluating strategic options or evaluate impact of strategy. So for example, this one here is evaluate options. So evaluate options to manage excess demand, evaluate options for mediating damage, evaluating options for proposal to sell products in schools. So they're going to give you 2 different options in the text, and you kind of have to weigh up the pros and cons of each strategy, linking it back to the text. So that's one option, is evaluating strategic options. The other category is evaluating impact of a strategy. Right? So for example, they might have a strategy to acquire a business. They might have a strategy to, wrong column. They might have a strategy to, a proposal, leasing excess capacity. So then you're evaluating the proposal. So all of these fall into one of those 2 categories. So thinking about it that way makes it a lot easier, because depending on what information is given to you in the qualitative release, you can have a look through and say, it might say in the text portion, they say, the owners are looking to vertically integrate the business. The option is to either vertically integrate or to, go and acquire another competitor, right? Those would be 2 options, and you could kind of assume the question's going to be that and start preparing a draft response based on that. So you can kind of guess based on the pre-release information. And then finally, question 3 is usually a question with regards to capital structure. And when I say capital structure, I mean what's the funding situation? So should we be funding this, whatever the scenario is, like an acquisition or vertically integrated, or maybe they want to do capex or expansions, they need money to do that. How do they get the money? Do they go and get a loan from the bank? Do they raise more capital? Do they sell shares? Do they divest a certain part of the business? These are all the kind of potential options for funding, right? And by doing that, you'll need to kind of compare forms of debt and equity and the pros and cons. For example, obviously equity, you don't get a tax deduction like you do with debt, but with equity, it's there are some benefits like the repayment priority, the risk level as well. So there's no debt covenants with equity and things like that. So it's just weighing up those different things and how that kind of fits in with the risk profile of the owners. So there you have it. Like, as you can see, these are about options getting cash to shareholders. What are the funding options for expanding facilities? Funding options for purchase of land. Funding options for divestment, IPO, buyout. It's all about these funding situations. So it's fairly straightforward when you think about it like this. Question 1 is going to be evaluate the business. Question 2 is going to be evaluate options or a strategy. And option 3 is evaluate funding, right? Now, CA is not going to tell you this, right? And they don't want to tell you this because if they do, it's going to make your life a bit easier and it gives you the power to actually pre-prepare. Whereas they want to teach you the skills to be able to think on the spot. But the reality is most people are pre-preparing. And the people who are preparing on the spot are generally going to do worse than the ones who pre-prepare. So yeah, that's why I recommend you take this approach. Okay, that being said, let's jump right into the first exam walkthrough, which is CAP417 2017. So we're going to walk through the pre-release background information because this is what you're going to get. And whilst we're doing that, we're going to pull out some of the key information as we come across it. Now, I'd expect you to do the same thing when you get this, and maybe it's not pulling it out into a Word document, maybe it's just highlighting it the first time round, and then later you can kind of look through it. Not all of those points that you've highlighted are going to be relevant or critical, but having read the whole thing, you'll have a bit of a bigger picture of what the questions might be asking you to do, and which one of those can we fit into these categories of evaluate business, evaluate strategic options, or evaluate funding. Now, some of them might not immediately be obvious, right? And it's only when you're writing the essay, then you can go back to your list of possible things and say, okay, sales might have gone up because of that, or working capital might have changed because of that, or inventory days would have gone down because of this, right? And even if it's not like a super clear link, if you can bring them into the answer, if you remember from the Rubric videos that we went through above, it's really important to actually link it back to the question where possible. If you don't link it back to the question, you're not going to get full marks. Now, the final thing that I want to go through with you is just the rubric, right? Now, for the purpose of these exam prep videos, I'm not going to spend time going through and explaining how to write it with regards to the rubric, right? Because we spent several videos in the earlier videos above going through in detail how to use the rubric, what constitutes a good exam answer. We gave you lots of examples, linked it back to the rubric, and showed you how to write it. So for the purpose of these videos going forward, we're assuming that is knowledge that you already have. It's assumed knowledge. So the only thing that I want to comment on the rubric for now is making sure that you understand that once you get to this final exam section, that you understand which rubrics are actually used for marking, because it's a little bit different from the written assessment from workshop 2. As you can see here, the rubric for the exam is analysis and evaluation and providing advice. So if we go down to the rubrics and just check, so analysis and evaluation, you would be familiar with this one already because that's the one we used for the written assessment, which is, correctly explain why it's an issue and linking it to relevant strategic information, which is what we're going to do, and explicitly explain why the client should be informed, okay? And also in your evaluation, explaining why you identified your principal concern, so at the end doing that, and explaining why all other concerns, right? But, we're basically going to be following the same structure as we did for the written assessment in the earlier videos. So it's almost identical. The only difference is the way they're marking it. They'll just be ticking it off against a different rubric, but it's the same approach. And then the other one was giving advice. So we still follow this written format, but it's just not being marked against this written format for the purpose of the exam. So this is the next rubric that they're actually going to be marking you against, which is advice is clear and relates to specific business problems and includes a justification for advice consistent with the associated analysis and or evaluation, and the advice is appropriate for the business type and size. So I don't think you necessarily need to keep this rubric open anymore. I think you understand how to approach and write a written response. You do it the exact same way as you did it for the written response in the earlier videos. You can watch those videos again if you need a recap on that. But otherwise, if you follow our essay structure and you remember how to do that from the earlier video, you should be fine. You don't need to keep referring back to the rubric anymore. But just keep it in mind, it is marked against this one. But in reality, how they actually mark it is they just look at it and say, okay, that's the right structure, tick, tick, tick. Okay, so let's just jump right into it and start reading the pre-release. And what I'll be doing is I'll put notes in this Word document over here. So anytime we see some information, even if it's not super critical, we'll just copy it across to our notes, and at the end we can start cutting it down if it's not relevant. Okay, so let's get started. So you are a newly qualified chartered accountant employed at the firm Pty Limited. The firm is a leading manufacturer and distributor of a wide range of pork-based products. So the company is privately held, based in South Australia. The firm was founded over 60 years ago by Windsor Range Group, a diversified multinational manufacturing group that was listed on the ASX in the 1990s. Windsor Range Group activities include meat processing and baked goods, as well as canned, frozen, convenience food products. In 2011, following strategic review of its business operations by the international management consultancy Mountbatten & Co., the Windsor Range Group embarked on a restructuring program that resulted in the divestment of all businesses considered non-core. One such business was the firm. Okay, so I might just copy and paste this. This might not be relevant, but we'll err on the side of caution. We'll copy it into our notes anyway. And we can come back to that at the end and delete it if it's not relevant. But it's better to have more rather than less. Okay, so next. In late 2011, the firm was sold as a going concern to two husband and wife partnerships, Wallace and Eddie Simpson, and Bertie and Beth King, each of whom also become directors of the company. Although the Simpsons are experienced marketing professionals, they have no previous experience or owning or managing a manufacturing business prior to purchasing the firm. I might just put that in. So Simpsons are experienced marketing professionals. We're just going to copy that. That seems like a key point. And also, the Simpsons have no experience of managing manufacturing business. Okay. All right. As such, the skills brought to the business by Bertie, an experienced operations manager, and Beth, a qualified food technologist. So I'm just going to copy Beth, experienced operations manager, and Beth, qualified food technologist. So Wallace and Bertie have been close friends since their school days and are excited at not only jointly owning a business, but also at no longer being the behest of others. Neither the Simpsons nor Kings have any experience in other parts of the food chain. So I'm just going to copy this. Simpsons nor Kings have experience in the supply chain. From running a piggery which supplies the meat to running a food retailer, such as any of those to which the firm sells. The acquisition of the business was funded by a combination of cash and debt, with both the firm's assets and the homes of Simpsons and Kings used as collateral for the debt raised. Okay, I might just put this in here. And also the fact that they paid for it, funded by a combination of cash and debt. Okay. And also, the bank included a number of covenants with the funding. Okay. The business has been successful since the Simpsons and Kings took over. Free cash flow has been used to pay dividends. Let's copy that. And pay down the business's loan. So things are going well. By the start of 2015, the business had paid off a significant part of its original debt. And the owners began implementing expansion redevelopment plans. Okay, let's just copy this. So the firm had also begun paying dividends in 2015, and the dividend payments continue to be welcomed by the Simpsons and Kings. Let's just copy this. The first 3 years were described as financially horrible by Wallace, with no dividends and little remuneration. Let's copy that. Things are looking out for the firm. So the governance and management. So the current board of the firm is as follows: Edwina Simpson, Wallace Simpson, Albert King, Beth King, Charles Shan, and Middleton. So Charles and Anne are independent directors. Charles, I'm going to just copy that. Charles is a commercial lawyer, and Anne an accounting professional, provide much needed business experience. Just copy these down in. In 2015, there was a major shake-up in the firm's senior management team. The owners voluntarily stepped down from their senior roles to focus on operations, food technology, and product development and marketing. Okay, I'll manually write in 2015 in my notes. 2015, okay. The board successfully appointed George Prince to the newly role of CFO, Charlotte Clarence as CEO. Heads of human resources and technology were also applied. So let's just copy this. Prior to her appointment, Charlotte was one of the general managers of a multinational cheese manufacturing company. George came from a horticultural business background. Okay, I'll copy that. For the last 2 years, SM&T members have received a non-contractual bonus based on the previous year's net profit, with the total bonus pool equal to 20% net profit. So I'll just copy this. Okay, other permanent staff have been loyal to the firm, and due to long service and regular small increases in wage rates, are well paid by industry standards. So let's copy this. And I'll manually type in permanent staff. Casual employees are paid. I'm just going to copy this as a separate point as well. Okay, next point, operations. So since the acquisition of the business, the Simpsons and Kings have been focused on gaining market share. I'm going to focus, I'll copy that. Winning a number of media awards for the firm's innovative media presence and for its innovative product range. Copy that as well. The firm's focus over this period has been to meet the latest demands from customers with an emphasis on offering new flavors and selections in the specialty range. Okay. Alright, this has been required a constant advertising presence by the firm to counter consumer uncertainty over what parts of the range are available at any given time. Copy that as well. The business has demonstrated that nimble response to meeting consumer demand has enabled its products to be marketed as premium goods with high margins. Let's copy that. With the work of Birdie on operations, the firm is considered to be operating as efficiently as possible based on scale and equipment. Let's copy that. In 2016, the firm obtained another loan from HM Bank. The loan was to fund a $1.5 million replacement of property, plant, and equipment. The loan included a 2-year fixed-term interest rate and carrying forward of existing debt covenants. The second phase of the replacement of PPE is expected in 2019, estimated at $1 million, with the board requiring that operating cash flow will be used to fund a significant part of redevelopment costs. So there's some important points in here. I just want to cut down the words. So I might just manually type some of these. So I'll say in 2016, firm got another loan equals to $1.5 million for replacement of PP&E. Loan included 2-year fixed term interest, carry forward of debt covenants. And then as a second dot point, I'll say second phase of replacement of PP&E expected in 2019. Cost equal to $1 million. Board requires cash flow used to fund most of this. Okay, cool. Alright, that's an important point. So next point is products. So the firm sells a range of products across 2 segments, specialty sausages and value sausages. So I might just type firm sells in 2 product segments. I'll copy this bit. Okay, cool. Next point. The different products have different profitability margins, the cheap margins. The cheaper value sausages have lower margins. So cheap value have lower margins as there's more competition. Okay, and customers purchase based on price. I'll do that as a separate point. Actually, I'll combine it. Next point, at other end, specialty sausage with higher margins. I'll just write specialty sausages have higher margins. These sausages require significant development costs and involve more time and skill of manufacture. This is an area that Beth King has led with her new and interesting flavor variations. So I'll say specialty sausages have, actually I'll combine it with the previous point, so I'll just show you what I'm doing. So specialty sausages have higher margins, but have significant development costs and require more time and skill to manufacture. Beth King has led this with new flavor variations. So I'm also going to say specialty, I'm going to call it spec sausages are less price sensitive, allowing both the development cost to be recovered as well as a higher margin to be charged. Just combine that point. In the last 3 years, have seen a focus on the sales and marketing of specialty sausages. There you go. Okay, so sausages are considered to be a substitute goods. Changes in income levels means that consumers can substitute within the sausage range and outside of it. So I'll just copy that. So I'll just bring this across the other screen now. Now that you can see what I'm doing. Okay, so with increasing consumer spending power, specialty sausages are often substituted for value sausages. Also, higher quality meats such as chops and steaks can be substituted for sausages as disposable income rises. So that's probably all one point. I'm going to copy that in. Okay, recent positive economic conditions have seen less value sausages sold, with customers switching to specialty sausages and higher cuts of meat. So let's copy that. Okay, suppliers. So the largest costs of the industry relate to meat. Most meat used in the manufacturing of small goods. So I'll just copy that. Most meat is pig meat, although smaller quantities. Should I just copy that? I'm just trying to cut down the wording. Most meat used in the manufacturing of small goods is pig meat, but some small quantities of beef used. Most meat is produced locally, although manufacturers use imported. Copy that. Okay, local piggeries vary in size with a few very large operators, but most piggeries are small businesses run by owner-operators. Let's copy that. Now, just while I'm doing this, I just want to remind you why we're doing this. You might be wondering, why are we going through and copying the key pieces of information? Because, once we get through all of this, because this is like 13 pages, it's a lot of information, you're going to forget most of it, right? So if we can cut out the useless stuff from here, and just focus on the key bits of information, we can retain the information a lot quicker, we can cut right to the important stuff, and then we can continue refining this list down and down until we just have a very refined list of just the critical points. And then once we're writing our essay, we can just refer back to this condensed list, as opposed to constantly referring back to this long, pre-release, and missing key bits of information that might be useful for our answer. So it's really just about getting rid of the fat out of this pre-release. Anyway, so back to this. So local piggeries vary in size. Do we cover that? Yep. And most of them are owner-operators. So the industry is subject to significant regulations. Let's copy that. Animal health, food and safety. That's an important point. Okay, and due to the array of regulations and animal husbandry skills required, it is a complex industry. The industry is also subject to, I'm not going to copy that because there's a bit of duplication with above. The industry is also subject to close scrutiny from animal welfare lobbyists who continue to argue for more humane. Yeah, it's not super critical, but it could be useful depending on what argument we're trying to push in our essay. Both the regulation and the scrutiny result in both increases in capital and operating costs for piggeries, although changes lie ahead are uncertain for piggery owners. The largest costs for piggery relate to feed. It's an important point. Most feed is with the price determined by global supply and demand. And pigs are also, that's probably got a separate point. So this point's probably important because it's going to say, okay, do we try and secure a local piggery, right, which will allow us to secure our supply chain and reduce the risk of price fluctuations on the open market. Pigs slaughtered at 26 weeks. This could be in relation to trading stock, or the trading stock is the pigs, right? That's your input. And if it takes 26 weeks to get that pig ready, if something happens, to a certain, it's basically going to comment on how long it takes for that inventory to get to market. The firm has a sole supplier contract with Penn Farmers. Okay, so sole supplier contract, that could mean, supplier power over this company. And if anything happens to that supplier, this company, the firm, is in trouble, right? So it's a good idea to sort of diversify your supplier contracts with Penn. Okay, Penn Avenue is a small owner-operator selling to a number of small manufacturers, including the firm. So, including the firm. So the firm does not purchase imported pig meat. Okay. But maybe they could increase their supply if they included international pig meat. But then what's the impact going to be on their supply chain, in terms of the quality and also, consumer preference? If they start using imported pig meat, are consumers likely to push back and purchase less of their meat? These are the kinds of things you need to think about. Okay, so the decision to have Penn Avenue sole supplier is about continuity of supply. Because there's moderate competition for quality locally raised pigs. Also, dealing with an owner-operator of a business is appealing to them. So it's also important to understand the mindset of the people in charge, like the board, and the executive team, and the shareholders, because when you're discussing strategy, you also need to keep in mind, what strategy is appropriate for the people you're presenting to. Okay, although compliant with regulations, Penn Farm is far from the most modern or efficient farm. So we could probably just rewrite this point and say, Penn Avenue is not modern or efficient. And the financial viability of the farm is mainly due to the long hours put in by Abe, the owner-occupier. So that's a good point there. If the entity is trading and insolvent, can they actually buy this business off Abe, if that's one of the options they're looking at? And also, if Abe starts wanting to get paid a salary, maybe the farm will shut down. So that's a risk. They've got all their eggs in one basket, and the basket is financially insolvent potentially. Other ingredient costs include preservatives, flavoring, packaging. These goods are sourced from a variety of suppliers. Probably don't need that point. Terms of trade from suppliers between 7 and 14 days. I'm going to copy that point. That might be important for our financial analysis of the business once we start looking at the numbers. Okay, next, customers. So the firm sells to a range of domestic retail customers. The owners like to stress their loyalty to both customers and suppliers. For most of its customers, the firm are sole suppliers of pork-based sausages, Payment terms are 30 days, which is considered to be the industry norm. Okay, so let's copy this point in here. That seems relevant. Payment terms are 30 days. Let's copy that. It could be important financial information or benchmarking once we look at the financials. Okay, current operations. So the firm has been operating at an average of 80% of normal capacity over the past 18 months based on production for a 40-hour week. That seems like an important piece of information for our calculations. And it's important because above they were saying up here that the firm was considered to be operating as efficiently as possible based on scale and equipment, but they still have extra capacity. Another consideration around capacity is their flex, right? Like if the industry is particularly seasonal, you need to create that extra capacity, or if you don't have that capacity there, you risk losing potential sales and that high seasonality bit. And also low capacity is obviously, not good for profits. So the last 3 months have been really busy for the firm. Not sure if that's relevant. We can always cut it out later if it's not, but let's just paste it in. In August, it was approached by a competitor, Stewart Small Goods Stewart. So Stewart needed to close its plants and rebuild. The proposal was that Stewart would continue to take orders from its customers, but it would pass the orders on to the firm. The firm will invoice Stewart for these orders. Okay, so we might have to reword this. So, competitor, Stewart, Small Goods, due to needing to close plant and rebuild, in brackets temporary, has proposed a partnership, or it's more of a referral agreement, where Stewart would take orders, refer orders to the firm. The firm will invoice Stewart with 35-day terms of trade, period of agreement equals 3 months, with the understanding the firm would not poach the Stewart's customers after this date. And then, okay, so that's one point. Let me just show you what I've written there. So the competitor, Stewart Small Goods, due to needing to close plant rebuild, has proposed a referral agreement where Stewart would take orders, refer orders to the firm. The firm will invoice Stewart with 35 terms of trade. Period of agreement equals 3 months, with the understanding the firm would not approach Stewart's customers after this date. And then as a separate point, I might just include this. I'm not sure if that's relevant or not at this stage, but I'm just going to include it anyway. Okay, so as a result of the implementation of the proposal for 3 months from mid-September, the firm operated above normal capacity. During this period, it sold predominantly higher margin specialty sausages. The additional production took little effort other than longer hours worked by manufacturing and distribution staff. Wages increased as overtime payments were paid to permanent staff, although where possible, the use of casual staff who are paid less than permanent staff reduced total wages. Okay, so there's a bit to unpack there. And we're trying to cut out some of the useless information. So the first thing I'm going to say is impact of referral agreement equals firm at above capacity for 3 months, sold higher margin specialty sausages, additional production took no incremental costs other than extra staffing hours. Wages increased due to overtime payments, though increased casuals, which reduced wages as cheaper per hour. Okay, so what's the risk is they've put on extra staff during that high capacity period, and then when those customers go back, they're still carrying those extra staff. They're going to have to get rid of them, otherwise their wages are going to go down. Alright, so the next point is around finance. So the finance department has been well resourced since the appointment of George Prince as CFO in 2015. Appropriate costing, management, financial reporting is carried out in the company subject to external audits. George is a CA with substantial experience in leading finance teams. He is a member of the SMT and a direct report of the CEO, Charlotte Clarence. Charlotte was delighted when she discovered upon her appointment that George had been appointed CFO and she had worked closely with him in a prior role. Prior to your appointment at the firm, you were employed within the audit and assurance team at Victoria Co., the current auditors of the firm. As a member of the audit team, you've gained familiarity with the business. You're excited by your appointment to the finance team, as the role is newly created and reflects the increasing importance that the CFO and board places on analysis and evaluation of business information. The balance date is 31 December. Okay, still in the pre-release information. So, summary of key debt covenant information. So the negotiated lending agreement between the firm and its principal banker include the following financial performance measures that the company must comply with. A, minimum interest coverage ratio of 2, minimum gearing ratio of 35%, minimum current ratio of 1.5. If the firm fails to comply with these terms, HM Bank has the right to demand immediate payment or full repayment of the loan, renegotiate terms of the loan, refuse permission for payment of dividends, levy penalty interest, and other financial penalties. So what I'm going to do is I'm going to summarize these key points. Usually debt covenant information is quite important because it could come into various different categories. Could come into the performance of the business. For example, if the interest coverage ratio is looking kind of dangerous, we can make a reference back to the debt covenant and say, if the interest coverage is too high, this may impact the business because it may give the bank the right to, for example, demand full payment of the loan, and then linking this back to why do we need to tell shareholders. Right, if they demand full repayment of the loan, that might challenge the solvency of the company, which is obviously a major risk, right? So that's usually a good one to link back to. So that's why I'm going to reference all of these points in the notes. So debt covenant terms. So I'll just show you what I'm doing over here. So I'm just doing debt covenant terms like that, and we'll go. Interest cover of equal or greater to 2, max gearing ratio 35%, minimum current ratio 1.5. Okay, failure, bank's power if debt covenant is breached, and then same approach. So immediate, I'll just move this back to the other screen, a bit easier to read. Immediate repayment of loan, immediate part or full repayment of the loan, renegotiate terms of loan, refuse permission for payment of dividends, levy penalty interest rates, and other financial penalties. Alright, so next one, George Prince, CFO, has returned from the office from his regular lunch with the CEO, and you've been called in the office to give a brief chat. Here's a transcript. So whenever we have a past exam, this is a really common feature, right? You get these transcript information. This bit here, whenever you see the transcript, because it's got the names and the text, this is usually an excellent indicator of what the questions are going to be. Like obviously we know, generally speaking, they're going to follow this kind of format from question 1 through to question 3. Right, unless they throw a curveball. But what they specifically want to know about, especially for question 2 and question 3, whether that's strategic. What's that strategic option? For example, is it about managing a wine variety? Is it their strategy for a new contract? Is it they're evaluating a proposal for doing some sort of operational thing? Is it an opportunity for managing excess demand? Whatever that specific qualitative thing is that we need to actually evaluate, which will give us the basis to write our essay, is probably going to come out from this section here, right? Okay, so let's read through it. So there's a lot of junk in here that's not relevant, like the general chit-chat stuff. Okay, so the first thing is the overdraft. So we have a meeting with the bank wanted to discuss our overdraft. When we took on more debt, there was agreement that we would keep the overdraft down. If it starts creeping up, the bank doesn't seem to concern. So what do we want me to do? I'm going to take the 2017 accounts to the bank when I go. I want you to provide me with analysis of these account. So what this is probably doing, right? See how we can kind of predict what the question is going to be. This is probably related to question 1. It's going to be something along the lines of evaluate the performance of the business in relation or in order to explain whether the bank overdraft is going to be an issue to the bank or something like that, right? It's going to be analysis and evaluate. That's almost a certain bet. And then in brackets, it's going to be in light of the new bank overdraft facility, right? Even if it's not that specific thing, most of the questions are going to be the same structure anyway. The only thing is just practicing linking it in. So for example, if our revenue is going up, that's going to be a good thing because it's going to allow us to, repay our overdraft a bit quicker, right? Assuming it translates to net profit. Either way, the rest of the structure is the same. You're still going to be talking about revenue going up if that's the outlier. You're still going to be talking about your, percentage going up. You're still going to be talking about why it's important, and maybe it's not going to be. Maybe in the end it doesn't end up being about the overdraft. Maybe it's just a general analyze the business question. It doesn't matter. You can just quickly adapt that in the exam instead of saying, if revenue goes up, that means more net profit. That means you can pay down your loan quicker. You're just going to say revenue goes up. That means net profit goes up if cost structure are the same, which means more money, which means you can afford to pay more dividends or have more cash on hand or spend money on it, which is just generally better for long-term sustainability of the business. Either way, you just adapt that same structure to whatever it is the question you're given on the day. So it's all about that adaptability. Anyway, this is a good hint that the first question is going to be around analyze the business with regards to the bank overdraft. Okay, so next is just remember that some of our KPIs will be meaningless because of the impact from sales to Stuart. Okay, they're referencing Stuart this time, so there might potentially be a question on Stuart. All right, next one is Charlotte has been telling us about one of the presenters from the business forum that she attended a few weeks ago. She's been thinking about this message and she thinks there may be some work for us. Okay, sounds promising. What did she find so interesting? Well, the presentation is engaged whereby led Andy Stark. He's the chief economist at Henry Markle Bank. He provided a series of scenarios for the Australian economy over the next 18 months. Charlotte is concerned about how well prepared the firm would be for whichever scenario eventuates. Charlotte wants us, which means you, to provide analysis of the impact of the scenarios of the firm. Okay, so all right, that's already basically telling us what the second question is going to be. Because if we have a look at back of our, some of our previous questions from other years, right, it's going to be about, analyzing worst case, best case scenario, right? There's a question here, analyze and evaluate the likely impact of the changes to the Australian economy as identified by the Squires Bank best case scenario on this. There's another one here, evaluate the impact on the change in the economy identified by the bank's worst case scenario on the operations, financial operations of the firm. So either way, the type of question is it's still an evaluate the impact of question, but we're just going to target it specifically to what it's talking about. So, for example, and they're not going to tell us what the scenario is, if it's a good outlook or if it's a bad outlook, until the day of the exam. But we can probably make a guess. Okay, so in this case, it's talking about interest rates, business confidence, the level of unemployment, So because we don't know whether it's going to be a good outlook or a bad outlook, this kind of prevents us from going into too much detail preparing our essay. But what we can do is we can actually prepare an answer for both a positive outlook and a negative outlook. And either way, we're prepared for both. We can just go and choose it in the exam, and then we've just written out our response. The other way we can do it is we can just write a single response and then put in brackets around the percentages, or even the sentences. Like you can just have a bracket, like if it's phrased positively, if it's phrased negatively, and therefore you're prepared for either scenario. All right, let's keep going. So you just need to provide analysis of the various aspects of the business, blah, blah, blah. So we already know what that question's going to be. Okay, the third item. So the owners have been thinking about the business and where they want to take it. They're keen on keeping the business in their current size and shape. They're worried about having all of their investment in one business. This is their only source of income. So Bertie has said as a proposal for the owners and board to start thinking about it in the coming weeks. Not sure what it's about, but it's behaving as if it's a real game of change of the business. He was talking to the owner of Penn Avenue last week, and I know Penn Avenue is short in cash. Okay, so already we kind of know what question 3 is going to be about, because as you know, it's all about, evaluating options, and it's usually to do with a capital structure, usually, an acquisition, and it could just be, evaluate the acquisition of a competitor, so evaluate a proposal to purchase a competitor. It could just be something like that. Or it could be a question along the lines of, how do you fund the acquisition, right? There's two possible ways of going about it. Most likely it's just going to be along the lines of, outline, basically the same as this one. Evaluate the proposal to purchase the competitor. So we know from our notes so far that we've written that they have a sole supplier, being Penn Avenue. So there's a major risk. What happens if that sole supplier goes out of business or decides to no longer sell to them or gets bought out by someone else and they decide to sell all the meat to China, right? All of their business is reliant on their sole contractor. Therefore, it's probably a good idea to go and purchase this business, right, and secure that. And maybe there's some cost synergies in that as well. So the question's almost definitely going to be along the lines of evaluate the proposal to buy Penn Avenue, basically. Or a small chance that it's, the owners have decided to buy Penn Avenue, outline two potential, funding situations, either with debt or equity, or just say outline potential funding. Most likely it's going to be the first option, but if I were you, I'd prepare draft responses for both questions, because out of all of the questions before it, this one's probably the least certain, to be honest. Okay, so that now we know what all three questions are just by reading the pre-release and looking at the trends in previous questions. So what else is the board thinking about? More generally, the board are concerned about the surety of supply of pig meat. Yep, that makes sense because it's the sole supplier and there's competition as well. And I think we need to look at in the context of how we fund it. We're a bit light on working capital, so a bit less working capital intensive investment could be good. So, that potentially could be hinting at, is this going to be one of those questions where it's talking about funding of the acquisition rather than just the proposal? But again, if we prepare for both questions, we're covered in either situation. And that's it. So as you can see, just reading this text conversation basically tells you what the questions are going to be, and you can write your draft essay based on that. All right, and then now in the pre-release, the final information is just the tables. So as you'll see, they only give you information for 2 years. But what you really need is you need the next year's financial information, and you only get that on the day of the exam. But that doesn't matter, because what we can do is we can still prepare multiple different responses. Let's say you need 5 in the exam, or maybe 6 at most. What you can do is you can prepare like 8 or something in your response, in your draft response, because you've got plenty of time before the exam. You won't have time in the exam. And maybe 3 of those won't be relevant once you actually see the information. Maybe there's no remarkable trend in them. That's okay. You just cross them out. You've got 5 other options there you can pull from. You use those answers. And obviously the first 5 minutes of your exam will be reading through the extra information, doing a couple of calculations, looking for the variations, and then saying, okay, what I need to talk about is revenue. I need to talk about sales and marketing. I need to talk about interest coverage. I need to talk about profit. I need to talk about, cash declining, trade receivable days, inventory days. I just do a bunch of calculations and then say, okay, these are the outliers. Therefore, these are the points that I need to talk about. I'm going to refer to my pre-written essay and use those points. And I'm going to use 5 out of the 8 that I've written already. There is some kind of draft responses that you can already prepare. But at the end of the day, what I would do is just based on the qualitative information, I would anticipate what the trend is going to be. So, for example, if we're worried that there's going to be an interest coverage issue because of those debt covenants, I might write a pre-prepared response based on the interest coverage ratio and say, the firm has reported interest coverage ratio of X.X in FY17, fill in the gaps when I did the exam, up from 2.2 in FY16. I know it's 2.2 because it says right there, so it saves me a little bit of time, right? And obviously if it doesn't go up, I can always go in the exam and actually just reverse the words and say, the firm had an interest recovery of X.X down from 2.2 in FY16. This means that for each dollar of interest the firm had paid on its interest-bearing debt, it had X.X of earnings. Right. Whilst this figure shows how Historic has been able to service its interest-bearing debt, 1.5 million debt is on a fixed interest rate. Now I'm linking back to the qualitative side of the business that we learned from the pre-release, blah, 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 blah. But as you can see, I'm now adapting the pre-written response. Anyway, that gets us to the end of the pre-release background information. So hopefully that really helped you get to the point where A, we have a list of key information that we've summarized in our notes over here. 2 pages worth of information, so that's condensed enough for me. And you might want to have another read through the pre-release again just to make sure you haven't missed anything. I think we've pretty much covered everything, but now we don't need to worry about all the the crap in between, which kind of confuses us and makes it harder to pick up on stuff. We've just got our key points here. Now we can move on to actually drafting our example essay. We've also got our questions. So if you remember, our guesses, which we're going to write a draft response on, but it doesn't really matter if we get it wrong because we can always adapt it in the exam, but at least we have something that if we get it right, we can get through it really fast. Maybe we get question 1 and 2 correct, so we'll get through those really fast and really easily. Question 3, maybe we got a little bit wrong, but then you'll just be in the same position that you were in anyway if you were just coming in and going to write the exam on the spot, right? But it just makes your life so much easier. So just to recap, we've got all the background information that we need. Question 1, we've got a very good idea that the question is going to be evaluate the performance of a business in the context of the banking overdraft, for example. Question 2 is going to be evaluate the strategic option. What was it again? Oh, it was and analyze and evaluate the impact of changes to the Australian economy as identified the bank on the operations of financial position. So you're basically saying, what's the impact if the economy goes up on the firm's operations, its performance and financials, right? So, for example, are they exposed to international exchange rates? Are they exposed to international interest rates? And things like that. And what's the impact going to be on their strategy? And then finally, question 3, we're anticipating the question is going to be around basically evaluate the proposal to acquire Penn, their supplier. Or we're also going to write a draft response just in case it's around funding. So the only step now is to actually write the draft response. We've got everything else we need. I'm going to go through that with you in the next video. I think this one's taking a little bit too long, but hopefully you found that useful. Next video, we're going to actually write the draft essay and link it back to the rubric and link it back to the key information, and you should be good to go for your final exam. Anyway, thanks for watching. Hope you found this useful, and see you in the next video.